Joining me now to break down the market action is Chance Finucane, Chief Investment Officer at Oxbow Advisors. Chance, your thoughts on today's market action?
Hi, Kristen. I think your point is right. After the last few days being strongly up, seems like everyone having a little bit more time to digest the Omicron variant compared to Delta. We have a little bit better idea so far of it being more transmissible, but not causing as many severe cases, and vaccines seem to be somewhat effective. So it seems as if everyone expects the economy to be a little bit more resilient, be able to manage through this better than everyone might have thought that day after Thanksgiving when the news first came out.
I guess the question that I have, though, Chance, when it comes to the path forward for this economy and this new variant is a delay to the return to work. What sort of impact does that have on the economy and thus the stock market?
If you look at every wave of infections we've had during this pandemic, the economic growth has been more and more resilient with each new wave. So even if there is some new restrictions that might have a temporary effect for a few months, we wouldn't expect that to be too damaging to economic growth. Where we're more focused is what the Federal Reserve decides to do in terms of accelerating its tapering plan and then also starting to raise interest rates, maybe with 2 or 3 hikes in 2022.
And of course, we do get that all-important Fed meeting just next week. But before that, we have an inflation report coming out tomorrow when it comes to consumer prices. The expectation does seem, Chance, that we'll see those consumer prices rise at an even quicker clip than we saw in the previous month. What is the expectation at your firm, and what does that mean for consumers?
Yeah, if you look, what's expected is nearly 7% inflation year over year is what will be reported tomorrow. About half of that is coming from higher energy prices and the higher goods inflation from the supply chain issues you're seeing globally. We wouldn't expect either of those things to go away anytime soon. The supply chain issues we'd expect to continue to be an issue well into the second half of next year. And oil prices fluctuate a bit right now with uncertainty about the return to normal demand for oil, if there's a little bit more restrictions in certain countries around the world. But the supply-demand dynamic in the oil space, I think, is going to continue to be a bit of an issue. So we would expect oil prices to stay at this level or even move a bit higher going into next year.
In terms of the Fed meeting, what do you expect, Chance? Because interest rates will dictate, we know, the path forward for this stock market.
I think seeing Chairman Powell come out and say that transitory no longer applies to this economy, they don't make a statement like that lightly. So we would expect that they will continue to accelerate this tapering, maybe finish it even earlier in the first half of next year so that they can start raising rates with probably 2 or 3 hikes next year. But it would have to be a real slowdown in the economy for them to go back on that from our perspective.
I'm just curious, too, we've got a lot of earnings coming in after the close. Chance, in terms of the state of corporate America, there do seem to be winners and losers for different reasons, even though collectively the stock market is rising. Any signs in particular that you're gleaning from corporate America at the moment?
One area that we're following is you're seeing lots of companies talk about inflation, whether it's in their freight or transportation of goods, the cost of goods and labor. But what we've noticed is that about 2/3 of companies are saying they're confident that they can pass through those additional costs either by raising prices to customers or finding cost savings elsewhere. So even though inflation has been more of an issue, it doesn't seem like it's going to be hitting companies' profit margins just yet.
Well, in terms of oil prices, I know that's another thing on many Americans' radar, investors as well, the expectation that oil prices will continue to rise in the new year. Is there a cap or a ceiling at which you think these oil prices can top off at? And what does that mean for the stock market?
We've seen some people predict that oil prices could go up to $100 next year. That's possible. If you had a real return to normal in the economy, we started to really come out of this pandemic, and there's still not a lot of marginal supply out there that could be added right away. You could see oil prices move that high, and that could cause a slowdown like it has over decades past, with causing a bit more of a recession because of very high energy prices. But I think that's just something we're going to be monitoring closely going into next year.
We have an earnings alert for Lululemon. Let's take a look at how Lululemon is doing in the after hours. That stock higher by 0.5% after the company did exceed earnings expectations as well as sales expectations. The company reporting earnings per share of $1.62. The earnings estimate was $1.41, and revenue coming in at $1.5 billion. The revenue expectation was $1.4 billion. This company also providing guidance for the current quarter, its fiscal fourth quarter, does see adjusted share price of $3.25 to $3.32 in this all-important holiday period, and fourth quarter revenue of $2.125 billion to $2.165 billion. Also sees full year earnings of $7.69 to $7.76. That is good enough to send this stock higher in the after hours, even though we did get a warning about the coronavirus. The company's saying the resurgence in COVID-19 and variants could cause additional restrictions, including temporary closing of retail stores. Again, Lululemon shares rising fractionally in the after hours, not quite at a record high, but still in the green after closing down on the session. Chance, what's your reaction to these results?
I think for anybody who follows Lululemon or retailers, this isn't that big of a surprise. They've been executing very well all through the pandemic. Their e-commerce business picked up very strongly over the last couple of years. So even if there are some restrictions or they have to close some of their stores, we would expect their e-commerce business to be able to pick up the slack. We also noticed some of the management commentary in the last couple of months suggests that even though they're going through some of the same supply chain issues as peers like Nike or Adidas, they still have been able to keep their shelves stocked, so we wouldn't expect that to be too big of a factor for them. For a company like this, I think the issue is just can they continue to execute and deliver on their 5-year plan? To date, they've been doing that very well, and I think because the share price has moved up nearly 50% in the last 9 months, the reason why there's a muted reaction in the share price after hours is just that this was already expected for them to deliver once again.
So let's talk more about comments from the company's CEO, Calvin McDonald. We are getting those in the wake of this report, Chance, and the CEO is saying that the results demonstrate the ongoing strength of the business with tremendous growth potential in both the near and the long term. Pleased with its early holiday season performance and how the company's brand continues to resonate in markets around the world. The company again saying a resurgence in COVID-19 and these variants could result in lower consumer demand, though, and disrupt the supply chain. Ongoing issues that we've seen over the course of the past roughly 2 years. But the company did open 18 new operated stores during the third quarter, ending with 552 stores. So its actual geographic footprint is very strong. A company with both a brick and mortar and an e-commerce presence, addressing the coronavirus, but also saying that the early holiday spending season is doing well. What are the reads that you've received so far about spending this holiday period?
Well, two things that you pointed out there. One, for Lululemon, as much as they have a great international opportunity, they still are more dominant in the U.S., so things like store closures you might see more in Europe than in North America. That's not going to affect them quite as much as maybe some of their peers. I think they also have really delivered well early in the holiday season. So we have noticed numerous retailers say that holiday shopping started early, and it seems like holiday shopping starts earlier every single year. But I think everyone has heard stories about you have to order whatever it is you need for Christmas gifts or holiday gifts earlier to make sure that they arrive on time. And I think that might have shifted some of the sales into even October before Halloween or Thanksgiving. So it's nice to see that they already have been delivering in that early portion of the holiday season.
Chance, gains on the S&P next year, will we see them? What's your take?
You know, it's interesting. I think it's possible they could continue just going on this trajectory, but valuations are high. You're starting at nearly 21 times on the price to earnings ratio. And with the Fed starting to taper and then raise rates, you're going from a monetary tailwind to now a headwind next year. So it'll be interesting to see. I think we would expect somewhat of a choppy market, which we always actually prefer, so that maybe it spits out some more opportunities for stocks we can add into our clients' portfolios.
All right, Chance Finucane, Chief Investment Officer at Oxbow Advisors. Chance, thank you so much for coming on the show.